With that said, Asian stocks gave up some of their earlier gains following a tech-led U.S. rally. Investors await the next set of U.S. inflation numbers due this week, which could hint at when the Federal Reserve might start cutting interest rates. Meanwhile, oil held the largest drop in about a month on signs of a weaker physical market, including a deep pricing cut by OPEC Plus leader Saudi Arabia. Gold prices picked up from a 3-week low, helped by a pullback in the dollar after an official U.S. report showed that consumers expected lower inflation, cemented bets for interest rate cuts from the U.S. Federal Reserve. However, we are going to be speaking shortly with our market analysts, and that would be Martin Smith from Anchor Capital. However, speaking of some of the Fed presidents that we did hint that will be talking to us during the course of the week, yesterday we had a couple of the Fed presidents indicating where they sit when it comes to interest rates. And I did mention that New York Fed President John Williams is the one that people are going to be paying attention to, and that is in relation to his stance around interest rates. Nonetheless, to get some perspective on those markets, we are joined by Martin Smith from Anchor Capital. Martin, thank you so much for your time. I mean, we've just kicked off the second trading week of the year. What's driving sentiment so far?
I think we've got a little bit of positivity still. Market's definitely a bit cautious given the moves we saw in certain parts of the market last year, and given where valuations are. And what do interest rates do? What does growth do? So still a little bit of nervousness, but starting slightly positive at the moment, given some optimism around rate cuts and normalization of rates and things kind of getting back to normal.
It was quite interesting. Yesterday, we had Patrice Rousseau, who's the Chief Investment Officer at Ashburton. And when it comes to, I suppose, some of the market darlings from last year, he says a sector of the market that dominated was the gold side. How are you seeing things? Are you off that view as well?
Yes, I mean, given kind of what you've seen from a macro perspective, you have seen quite a nice rally in gold, but I think still comes back down to growth stocks as you have this rhetoric in the last few months changing around rate cuts being maybe a little bit more aggressive in the States. You've seen a real kind of flurry towards growth, and that kind of continuing, even though you've seen these stocks up already 30, 40, 50% throughout the year. So it's been growth, and maybe you've seen a little bit of a rotation into things like value, into kind of second order technology stocks, but the darling still seems to be growth shares with a slant on technology.
What's your conviction then going into 2024 on those big tech shares?
I guess they've probably got to start delivering. I think you saw a lot specifically around the AI space, a lot of kind of exuberance and a lot of things priced in on future earnings and the like. And I think the market also needs to see some of that start to materialize in earnings the next kind of 1 to 2 to 3 years. So long term, I think the prospects are there, provided these companies actually start to deliver and they can justify the valuations they're on. Short term, there's definitely the chance of a little bit of a pullback given the very kind of significant moves we saw last year. So I think just want to keep an eye out on it.
So Friday, we've got, the banks kicking us off for U.S. earnings for the fourth quarter. How high is the bar for this particular quarter? And also, what are we looking for?
So I think it comes down to now the fact that earnings growth really needs to start to come through, and we need to see some proper momentum from that aspect. Because you obviously saw the market stomach some kind of negative data for most of last year and a bit of the year before. And that was fine, given that we all expected it, kind of given the backdrops. But now you've seen things turn positive, and we really need to see that kind of continue, that momentum continue from an earnings perspective. Again, back to my point around valuations, the market isn't looking particularly cheap, and you need to see earnings growth kind of play its part to justify the valuations that we're seeing across the market. So I think that's going to be the biggest thing to keep an eye out for, is that continued momentum in earnings and whether that actually starts to come through or not.
The one thing I've heard a lot of analysts, including members of the Fed, say is that they are very data dependent. And as a result, this market is kind of, waiting for a lot of the data. If this is a data dependent market, which data are you leaning towards? Is it the soft or the hard data?
I think coming back to the points around growth from companies from an earnings perspective really starting to need to come through. I think that's a very important one. But I think broader macro terms, I think it comes down to growth or GDP growth, inflation, as well as interest rates. I think those are the three biggest things, and apologies for being a bit of a cliche and choosing more than one, but I think those are the three biggest things, and how they relate to each other, I think is going to be quite a big part of the next kind of 12 months. Everyone's talking about rate cuts, but is it because we're cutting rates because you're seeing growth really come off a cliff? So there's lots of kind of moving parts in the equation, but I'd say those are the three most important, as cliched as it is.
With those moving parts, as you talk about, at least probably for the next 12 months, what are some of the lingering concerns that we might be taking from 2023 into this year, or some concerns that are completely new?
I think it comes back to, again, the story around rate cuts. One, you could have this situation where cuts don't happen as quickly as the market expects. So, I mean, some people even think we could see one now in the first quarter. We personally don't think that'll happen, but you could see some nervousness around rates not being cut as aggressively as the market would like, which you could see the market come off a little bit. And again, you've got that kind of elevated valuation kind of backdrop on the market offshore. And the other thing is that rates have to come off quite quickly because you've seen economic growth come off quite quickly. So there's two moving parts from that perspective. So I think it all kind of hinges again down to kind of interest rates. I think that's where the big thing lies this year.
Before I let you go, how are you seeing the SA consumer faring this year?
I think a little bit resilient was what we saw last year. Obviously, lots of challenges reflected very much the share prices of those consumer stocks. But as interest rates start to come off a little bit, kind of second half of this year in SA, and as we hopefully see a little bit of growth come through, I think the SA consumer might be on a slightly better foot than they were last year.
All right, Martin, let's leave it there. Thank you so much for your time. That is Martin Smith, who is a portfolio manager at Anchor Capital, and looking at the rand right now, trading at 18.66. And of course, we are watching the price of Brent crude, which is currently at $77 a barrel. We're going to take a quick break, and when we come back, we'll have more news for you, so stay tuned.